Hey there, thanks for tuning in. Welcome to Investing in Germany. And today let's have a quick look on the market last week. So, first we have the CPI number coming in for the American. So, United States of America, CPI is nothing but the consumer price index, or in short, it's the inflation rate. So, they have reported a 6.5 percentage inflation in the month of December 2022 compared to 7.1 in November 2022. So since almost from June, July, the inflation rate is slowly and steadily coming down for the American market. This is really good news for the Fed, which is the central bank of the America, and their rate increase is really helping them in bringing down this inflation. I think we will also see similar trend from the ECB, but then whether we are going in such a steady pace downwards is something that is questionable, and we have to see the final data. But we will closely follow the American CPI numbers here. And let's go to the next one. The World Bank has released the forecast for the year 2023, and the World Bank is predicting the overall economy around the world. The whole world will increase, or the growth will be at 1.7 percentage. This is quite less compared to what we would like to have, right? So if you can see that the European Union or Euro area is completely around 0 to 0.1 percentage, the most of the growth is coming from the Asian countries, China, India, and also sub-Saharan African countries. So they are really bringing out the growth for us in 2023. If you look a bit deeper into the same metrics, so in Germany, they are predicting to have 0.1 percentage growth in 2023. It's close to zero, or we have to wait and watch how it really comes out for the next year. But then all the energy crisis is almost behind us, and there seems to be some control on the energy price inflation, and also the overall inflation is really cooling down in Germany as well as in Euro area. Therefore, 0.1 percentage maybe looks feasible, but we have to check how it progresses, because now the details are really fluid. And if you compare that with the Euro area is projected to grow by nothing, 0 percentage. This is quite a number, because it's like a cat on a wall. It can go this way or that way. If it goes down, then the market will react negatively. If it goes up, the market will cheer up. So the next year is going to be really, really volatile. But then this is good news. We are not projecting, or the World Bank is not projecting that Euro area is going to contract. But some countries will contract within the Euro area, but we have to see how it really progresses in the next months. And then from there, we go to the Euro area wage inflation. So the inflation is really peaking out, or maybe peaked out for us, but we have to wait and watch how it really progresses. But then the energy crisis is almost behind us, thanks to the warm winter we had, or the spring winter. So this has really helped in bringing down the inflation quite significantly. If you look at the past 2 or 3 months, you can see that the inflation or the wage has slightly gone up, and we have to see how it progresses, because it has a really negative impact in bringing down the inflation. If the wage inflation starts going up in this trend, then probably the ECB, the European Central Bank, might start increasing another round of interest rate to combat this increase in the wage. Within the Germany, we have a wage increase from May or June 2023, based on the last alignment with the employers, the biggest workers' union in Germany, the IG Metall. And then there is one more price increase, or the wage increase next year. So there is quite a number of wage increase coming in for this year, and as well as for the next year. So from the Germany, there should be some impact here to the wage inflation. So we have to wait and watch how it really brings in here. But then European Central Bank is also doing the quantitative tightening, so that should also help us in combating the wage inflation. And then the Russia oil, the one of the most important or most widely sold grade from the Russian oil is the Urals. Here you can see that it has really plummeted in the last weeks. So the G7 countries, they have set the seaborne shipment of this oil to be at $60, which is quite high compared to the price it was trading at, and now it has even gone down. And currently it looks like only China and India are buying the Russian oil, and all other countries have moved to other sources. The China and India are really having a good time in sourcing those cheap oil. But of course, this is negatively impacting Russia, because they are now constraint of the cash to fund their war with Ukraine. So this price downward trend will really impact Russian economy as well as Russian free cash available for them to work on. So let's wait and watch here, but this is a really bad blow for the Russian oil and Russian economy. And finally, we have this Morgan Stanley client survey reported on the January 2023, where the clients are really focusing and preferring to invest in China or in Europe. The US is now out of focus for them because the US stocks are still highly valued compared to the Chinese and the European stocks. The Chinese stocks were really hammered down in the last number of years due to the government interference and the unknown, unprecedented mass lockdowns. A lot of issues with their property market within China due to the Ponzi scheme and so on. But now the China is slowly coming out of all those tightness that they created in the last 1.5 years. The zero COVID policy is out. And then we have the Lunar New Year or the Chinese New Year, where they have opened up the entire economy. And they are really facing a lot of deaths due to the COVID, but then this should all peak out or maybe they already picked out. So we don't know the data really coming out of the China, but then we are really close to going into the end of this issues here. From the Chinese market, all the internet stocks like Alibaba, Tencent, JD.com, Pinduoduo, everything were like extremely hammered down. But now because of all the positive news coming in from the Chinese and the Chinese government really letting loose all those companies, we have the Ant Group from Alibaba coming in for IPO. So at least there are rumors where they are really focusing on the IPO. And then we have Tencent, which got the approval to launch their video games. And there are really good signs, positive signs coming in from the Chinese market. And from the European stocks were not really good participant during the bull run because of the nature of the business they are in. And the businesses where Europe is, they are really more go into the bull run when the interest rate is high and a lot of heavy industry and luxury market, which is where European markets are really focusing. And this year and the next year should really do well during the high interest rate environment. They should really fare well during the high interest rate environment and low growth environment. So European stocks are really still cheap, even though in the last week or so they have really gone up after the good news coming in from the American PMI data, as well as the warm winter, which created really good positive vibes within the investing community within the Europe. And also, the energy crisis, which is slowly going behind us. So therefore, there was a really good, significant positive movements within the European market, which will come into a bit. But then this is all really good news. And even with all the increase in those valuation or the price in the market, the valuation is still behind the American stocks. Therefore, it makes sense to invest in China and Europe. So let's have a look at the market in the last 5 days. So to start with, so this is the Stocks Europe 600 index, which is more or less close to the S&P 500 index. The Europe 600 tracks the top 600 companies within the Euro area. And then you have the S&P 500, which tracks the top 500 companies in the America. And then we have the Crane Shares KWEB. This is an ETF which tracks the Chinese internet company, which is more or less a good relation to compare from the Chinese market perspective. As you can see that in the last 5 days, we have the S&P 500 really gone up on positive news on the CPI, and the market is now expecting that the Fed will not increase the interest rate by 50 basis points, but rather 25 basis points. And even there are some analysts predicting that the Fed might even pause a bit more or even start reducing the interest rate because the inflation has peaked. So there are really some really positive news, positive vibes going into the market based on the new CPI number. That's why you can see that S&P 500 have really done well in the last 5 days. And the stocks, European stocks, has also done well because one, cheap valuation, and also if the positive news comes from China, from the America, then the European market will also follow them. So the international market follows the American market. So it's more or less given there. But if you look at the last 1 month perspective, you can see that the S&P or the S&P 500 has not done much well compared to the Chinese stocks or the European stocks. So this tells us almost the same what the clients are preferring from the Morgan Stanley service. So I think the market here, the money is flowing from the highly valued American stocks to the cheaply valued internet stocks in the China as well as in the Europe. So this is the trend that is already there. And then I think this should also still continue for this year or maybe even into the next year, because the American stocks, even though they have come down really significantly down, but then they are not yet reached to a valuation where they are still investable compared to the European stock. The European stocks are still cheap compared to the American stock, and the Chinese stocks are of course really cheap compared to the European as well as the American stocks. But then investing in China is a bit tricky, because if you look at the last 1 year perspective, you can see the Chinese stocks are really, really volatile. As soon as some news comes in from the market, and then the stocks goes crazy. And you can see that the KWEB, the ETF, has so much of minus 40%, almost 2 times, and then there's gone to minus 30%, almost 1, 2, 3, 5 times in 1 year. So that is a really crazy amount of volatility. If you can weather through this volatility for a long period of time, then it makes sense to invest in Chinese stocks, because here it will be extremely volatile based on the government policy actions and the news coming in from the Chinese market. Stay tuned. See you in the next video.